topic is financing of debtors. How debtors have to be financed. So the first method is invoice discounting. Basically, for example, the company has total invoice of debtors is 450,000. Company needs money now, and this amount has to be received, for example, in 60 days. So company goes to the bank and asks the bank, these are the invoices of my debtors. You give me money today. For example, they decide an amount for 30,000. So the bank pay today this amount to the company. After 60 days, the company will collect. Who will collect? Company, which is borrowing money. They will collect 450,000 and this amount will be paid to the bank. So basically this 20,000 is the difference. We received 430,000 now. After 60 days, we will collect from our customers the 450,000 and will pay to the bank. So difference of 20,000, that is called basically interest on this loan. And in other words, in other way around, so we can say 450,000 invoice we got discounted from the bank at 430,000. Okay, so that is called invoice discounting. So now here the benefit is that company is retaining the control of the whole process. They are retaining the sales ledger, credit control, even collection is from the customer will be done, receivable will be done by the company itself. And yes, discounter is repaid when the customer settle invoices. Means in 60 days, our customer will pay us and will pay to the bank. Bank is the discounter. Bank is the discounting that invoices for us. And then, yes, it works like secured overdraft. So means that the bank 430,000 is secured on invoices of 450,000. That's it. Now, so yes, so customers do not know. To the person who has to pay me 450,000 and then I'll pay that money to the bank, they do not know this arrangement of invoice discounting. Okay, so this is used for the temporary cash shortage, improves liquidity short term, and it cannot be used on a regular basis. Yes, seasonal, sometime you need all of a sudden because of the peak season of the business, you need cash earlier, so you can utilize that. Now the second method of financing the debtor is called factoring, debt factoring. Again, debt factoring is an arrangement. Again, you are getting the cash from the bank or finance company, which is called factor here, against the receivables. But here the difference is there, that you are getting the prompt cash, but you are selling receivables to them. Means they will manage the receivables, they will collect the payments. Okay, so we are not going to manage now. In the invoice discounting, we were doing that. Now the second is credit control. Okay, so factor, the party which is actually providing this service, that they're giving cash to us today, so they check the credit worthiness of the customers, follow up them, and sometimes manage bad debts as well. So what they do, for example, again, the amount is 600,000 receivables dollars. So we go to a factor, we say collect it. So on our behalf, so factor, what does they do? It is a bit different arrangement. For example, normally 80% they advance of this money to us. So 80% of 600,000, that is 480,000. So factor gives this money to us as a loan and they charge interest over it, which is some margin above the overdraft rate. For example, overdraft rate is 4%. They may give this us to 6%. So they advance this money to us. Remaining 20%, of course, they will not give that money to us, only 80%, 70%. So then later on, they will charge, they will collect the money from the customer as well. And they charge factor fee as well. Factor fee. That is maybe 0.5%, 1% of total sales, credit sales, or mean whatever is agreed with them. So now, so factor fee 2 to 3% of invoice value. They charge, yes, advance they make, they charge interest. And then types of factoring. There are the two types of factorings. One is called with recourse factoring. What is with recourse factoring? And the other is called without recourse factoring. Without recourse. It is also called non-recourse. The difference is because bad debts risk. So without recourse or non-recourse means there's zero bad debt for company. Factor will take responsibility. Factor will take responsibility of bad debts. So and they charge higher fees then. So means that, for example, we were having bad debts before 1% of sale or 1% of receivables. We sold the receivable to the factor. Now zero bad debts, but they will charge high fee because now risk is transferred. With recourse fee, that they bad debts is not zero. Whatever bad debts will be, that will be related to us. No guarantee against bad debts. Now, how to evaluate a factor proposal? Exam question is like that a factor has offered a proposal. So how you will evaluate it is financially beneficial for the company or not. So for example, so again, just like invoice early settlement discount, we did that. We have to calculate current cost of managing the debtors. What is the current cost? And what is that? First of all, that is and the second is you have to calculate cost under factoring proposal. So current cost, and then compare the both. And we see which one is having lower cost of receivable. We will go for that. So starting with the current cost. So finance cost of average receivable, we calculate average receivables using the same formula. And then we calculate finance cost. And then what are the current bad debts? What are the administration or other costs related to the receivables? We calculate sum of all these costs. And then we calculate cost under factoring proposal. So revised receivables are calculated and their finance cost is calculated then. Right? Finance cost is of two types. One is paid to the factor, the other is paid to the bank remaining. Okay? So residual bad debts, if any, and then remaining credit control costs, if any, and then factoring fee. Okay, so interest charge on, I already said, cash advances and on the bank loan. So basically, these two are related to the point number one. Two types of finance. 80% finance is advanced by the bank, by the factor. So so interest will be paid on to the factor. Remaining 20% receivables will be financed through the overdraft, and it will be charged, the cost will be charged at overdraft rate. Now, so we will calculate total cost here and we compare the both. Which one is lower? We say it is worthwhile. Now, so yes, some qualitative factor. When you sell your receivables to factor, what happens? Your goodwill is affected. May be affected because factor has to recover money at any cost. They don't have to deal the customer with courtesy, which the way we will be dealing. So customer may get disturbed. Okay. Second is confidentiality, because customers' record is confidential with us, their contact information and what they owe to us. That may be the concern, and that may be under subject to certain laws as well. And yes, credit control department now we no longer need, because we are using factor services to collect our money. So we have to remove them. So their redundancy cost and the legal repercussions we need to consider. Now, example is here in front of you. Delta company makes annual credit sales of 60 million. Average receivables are 5 million PKR. The company suffers bad debts of 1.8 million of sales annually and spends 1 million per year on credit control staff. Current receivables are financed by the overdraft rate at 6% per annum. 6% per annum. And then the factor has offered the following terms. 80% of receivable will be financed at 9% per annum. Factoring fee with recourse and without recourse is where bad debts are zero. Remember that. Okay, now, so with recourse, 2.2% of sales. Calculate current cost of receivables, net cost of factoring with recourse, without recourse. Compare options. Recommend which option is? Yes. So briefly discuss risk trade-off between with recourse and without recourse. Okay, we will talk one by one. So we have picked this data. Annual credit sales, average receivables, current bad debts, we have calculated. Credit control costs, 1 million. Current financing overdraft and factor option, 80% of receivables at this rate, factor fee. So you see, we have picked all the data. This is very much important to identify data. Now, the current cost of receivable, no factoring. How to calculate? So 5 million are receivables. 5 million are receivables. They will be financed at 6% overdraft rate. So 0.3 million is the annual cost, finance cost. Then bad debts will be there, 1.8% of revenue. 1.8% of revenue. Like this. This is the 1.08 million. Okay. Then is credit control, 1 million. Then we proceed towards what is the total current cost, sum of all. So this current cost calculation is very easy. Now we will evaluate the factor offer. So there are some cost which is finance cost. 80% of receivable will be financed by the factor at this rate. And remaining 20% will be financed by the overdraft, bank rate. Okay, so that is the same in the both cases, whether it is with recourse or without recourse. So first of all, we will be calculating finance costs. So 80% of receivables at 9% will be, so these are the total receivable, 5 million, 80% and 9%. So remaining 20%, so 5 million into 20% at overdraft rate of 6%. So this is the total finance cost of factor, a receivable under factor option. Okay. Now, so then when there is a with recourse, so with recourse factoring, so what will happen? There will be, first of all, that is factoring fee. Factoring fee. So 2.2% of sales. So 60 million, that is the factoring fee. Then there is zero, I have zero credit control cost. So that 1 million will be ignored here. Then is finance cost, this brought down. And then is bad debts, which is already, because it is with recourse, bad debts will remain the same. They have not reduced. Okay, they have not become zero. So total cost of receivable under factor option with recourse factoring is here. So from the current cost, it is increased. So let us talk about the next without recourse factoring. Without recourse factoring. So this is what situation? Current one. Now, so next proceed. So without recourse factoring, factor bear the bad debts. Bad debts are zero. The first cost is factoring fee, 3% of that sales in front of you. The second is finance cost is 0.42 million, which is same. Zero bad debt. Bad debts are a responsibility of the factor. Now, net annual cost is 2.2 million. Now, what is the current cost? Current cost was 2.38 before factoring. So this is cost with this factor is 2.2. Saving, cost saved, 0.16 million. So with recourse factoring is beneficial. So what is the recommendation? So without recourse, it saves money. right? So with recourse, it is worse. Now, so risk, non-recourse removes bad debts risk. Okay, with recourse is costlier, so hence, so choosing non-recourse factoring unless there are qualitative concern, same customer reputation, customer relationship, confidentiality. So we will go for here without recourse factoring, this which is financially viable if other factors are of not that importance. Now, what are the advantages and disadvantages of factoring? The first of all, you transfer the control of the receivable to them and you save these costs. Okay, then management can focus on other areas. Now they need not to focus and spend time on recoverability of receivables. And then of course you will get immediately finance of receivable 80%, 70%, whatever is decided. Increase sales, increase finance you will get, right? Cash flow is improved, of course. Your and if there is a non-recourse factoring, zero bad debt. Okay. Now, so very important. Factors are expert in this job, recovery of receivables. Okay. And they have expert people. They have, of course, they have achieved the economy of scale in providing this service with the time. So we have access towards expert services we may not be able to afford otherwise as our employee, right? Then disadvantages. Yes, it is costly. You have to pay two things: increased interest rate and second factor fee as well. So you lose direct contact with the customer. Customer goodwill may be damaged. They may, pressurize customer to pay the money and damage the reputation of business with the customer and their linkage as well. And yes, once you outsource, to establish an in-house department, it is difficult, very difficult. Yes. So when the such department is outsourced, the market may interpret about the company is struggling with cash flow, they need money, they are desperate, they're otherwise unable to recover cash, so they have hired a factor company who advance them money as well as recover from the customer. Now, so that's another question for you people. You will be trying this question on factoring. Note it down and you will be sending me on my WhatsApp number. You have my WhatsApp number. I will review and I will be commenting on that. Thank you.